You could be losing thousands every year to brokerage fees without even knowing it. It's like a silent thief, taking from your investments. Are you sure you're getting the best deal from your broker? Even small fees can add up over time, money that should be compounding in your account. In this video, I'll expose everything you need to know about brokerage fees, from the obvious to the hidden costs. I'll show you how these fees can eat away at your returns, and give you strategies to slash them, keeping more money in your investments. Let's get into it. Let's start with the basics. Brokerage fees are charges by firms for their services, like buying and selling stocks. These fees can come in various forms, and understanding them is crucial for any investor. Whether you're a seasoned trader or just starting out, knowing what you're paying for can make a significant difference in your investment returns. These fees keep their business running, but it's crucial to know if you're getting fair value. Are you receiving the services and support that justify these costs? Or are you paying for features you don't even use? It's important to evaluate the value you're getting in return for these fees. Brokerage fees vary widely, from per-trade commissions to account maintenance fees. Some brokers charge a flat fee per trade, while others might have a tiered structure based on your trading volume. Additionally, there are fees for maintaining your account, which can be monthly or annual. Understanding these different types of fees can help you choose the right broker for your needs. While many brokers now offer commission-free trading, there's often a catch. These zero-commission trades might seem like a great deal, but brokers still need to make money. They might do this through other means, such as selling your order flow to high-frequency traders or earning interest on the cash in your account. Inactivity fees, transfer fees, and mutual fund transaction fees can also add up. If you don't trade frequently, you might be hit with inactivity fees. Transferring your account to another broker can also incur costs. And if you invest in mutual funds, there might be additional transaction fees to consider. Even small fees can have a massive impact on your returns over time. A few dollars here and there might not seem like much, but over the years these costs can add up and eat into your investment gains. It's essential to be aware of all the fees you're paying and how they affect your overall returns. The landscape has shifted from high commissions to zero-commission platforms, but hidden costs remain. The move to zero-commission trading has been a game-changer, making investing more accessible to everyone. However, it's important to stay vigilant and understand where brokers might be making up for the lost revenue. Brokers find new ways to make money, like payment for order flow or interest on cash balances. Payment for order flow means brokers get paid to route your orders to specific parties, which might not always result in the best execution for you. Additionally, brokers can earn interest on the uninvested cash in your account, which is another way they generate revenue. Understanding these fees is key to being a savvy investor. By knowing what you're paying for, you can make more informed decisions and potentially save a significant amount of money. It's all about being aware and asking the right questions. Read the fine print on fee schedules to know what you're signing up for. Fee schedules can be complex and filled with jargon, but taking the time to read and understand them can pay off in the long run. Don't hesitate to ask your broker for clarification if something isn't clear. Fees differ based on the assets you trade, like options or mutual funds. Each type of investment comes with its own set of fees, and these can vary significantly from one broker to another. Make sure to compare these costs when choosing where to invest. Your strategy should align with your broker's fee structure. If you're a frequent trader, look for a broker with low per-trade fees. If you prefer a more hands-off approach, find one with low account maintenance fees. Aligning your investment strategy with the fee structure can help you minimize costs. The competition has driven down fees, but transparency is crucial. As brokers compete for your business, fees have generally decreased. However, transparency about these fees is more important than ever. Make sure you understand all the costs involved before committing to a broker. Knowing these basics helps you build a strategy to minimize their impact. By being informed about the various fees and how they can affect your investments, you can develop a strategy that minimizes their impact. This knowledge empowers you to make better financial decisions and ultimately achieve your investment goals. Now, let's dive into hidden costs that can silently eat away at your profits. Many investors are unaware of these costs, which can significantly impact their returns over time. One of the most common misconceptions is that commission-free trading means no costs. However, brokers still need to make money, and they do so in ways that aren't always transparent. Commission-free trading isn't out of goodwill. Brokers still need to make money. One major way they do this is through payment for order flow, or PFOF. Payment for order flow (PFOF) is a major hidden revenue stream. Essentially, your broker might route your trade to a third-party market maker, earning a small fee for doing so. While this might seem harmless, it can affect the execution price of your trade. Over many trades, these small differences can add up to a significant hidden cost. Another hidden cost comes from the bid-ask spread. This is the difference between the price at which you can buy a stock and the price at which you can sell it. Bid-ask spreads can also impact your returns, especially in volatile markets. The wider the spread, the more it can eat into your profits. If you trade on margin, borrowing money from your broker to buy stocks, you'll face another hidden cost: margin rates. These are the interest rates charged on the borrowed money. Brokers charge interest on margin loans, which can vary widely. High margin rates can quickly erode any profits you make from your trades. Additional services like premium research tools often come with extra fees. While these tools can be valuable, it's important to assess if they are worth the cost. Always evaluate whether the benefits of these services justify their costs. Sometimes, free or lower-cost alternatives can provide similar value. Currency conversion fees can be high for international investments. If you're trading in foreign markets, these fees can add up and reduce your overall returns. Mutual funds and ETFs have their own fees, such as management fees and expense ratios. These costs can impact your bottom line, so it's crucial to understand them before investing. Poor execution or platform reliability can also cost you. If your trading platform is slow or unreliable, you might miss out on profitable trades or face unexpected losses. Be aware of these hidden costs to protect your investments. By understanding and accounting for these fees, you can make more informed decisions and maximize your returns. Let's compare some big players in the brokerage world. Each of these firms has its own strengths and weaknesses, catering to different types of investors. Whether you're a seasoned trader or just starting out, it's crucial to understand what each broker brings to the table. Fidelity and Charles Schwab offer $0 commissions, making them attractive for cost-conscious investors. However, it's important to check their margin rates if you plan on borrowing money to trade. These rates can significantly impact your overall costs. Vanguard is great for long-term investors with low-cost index funds. Their focus on low fees and diversified portfolios makes them a favorite among those looking to build wealth over time. If you're planning for retirement or other long-term goals, Vanguard is a solid choice. Robinhood and Webull offer commission-free trading but rely on PFOF, or payment for order flow. This means they make money by routing your orders to market makers. While this allows for zero commissions, it's essential to understand how it might affect your trade execution. Interactive Brokers is ideal for active traders with low margin rates and a robust trading platform. Their advanced tools and low costs make them a go-to for those who trade frequently and need a reliable platform. Compare brokers based on your trading style and needs. Are you a day trader, a long-term investor, or somewhere in between? Your choice of broker should align with your specific requirements and goals. Active traders should focus on per-contract fees and platform stability. High-frequency trading requires a platform that can handle large volumes without lag, and low per-contract fees can save you a lot of money in the long run. Long-term investors should consider expense ratios and account perks. Lower expense ratios mean more of your money stays invested, and perks like financial planning services can add significant value. There's no single best broker, it depends on your priorities. Whether it's low fees, advanced trading tools, or excellent customer service, identify what matters most to you. Look beyond headline claims and read the full fee schedule. Hidden fees can add up and eat into your returns, so it's crucial to understand all the costs involved. Check fees for transfers, statements, and specific securities. These additional costs can vary widely between brokers and can impact your overall profitability. Find the broker that offers the best value for your needs. By carefully considering all these factors, you can choose a broker that aligns with your investment strategy and helps you achieve your financial goals. Now, let's talk about minimizing fees to maximize returns. Choose the right broker for your trading style and frequency. Understand what commission-free trading entails with your broker. Consolidate accounts to meet fee waiver thresholds. Limit trading frequency to avoid unnecessary costs. Use limit orders for better execution prices. Avoid upselling for services you don't need. High net worth individuals might negotiate fees. Always read the fine print and review fee schedules. Regularly check your statements for unexpected fees. Vigilance is your best defense against fee erosion. Brokerage fees can erode your portfolio over time, but you can minimize their impact. Understand the basic landscape of fees from commissions to maintenance fees. Hidden costs like PFOF and margin interest can add up. Compare brokers to find the best fit for your strategy. Look beyond zero commission to other fees and services. Use practical strategies to minimize fees like limit orders and account consolidation. Read the fine print and review statements regularly. Be proactive in managing your investments and fees. Challenge fees and strategize around them. Protect and grow your wealth by minimizing costs. That was a deep dive into brokerage fees. If you found it valuable, smash that like button. Share your experiences with brokers and fees in the comments. Subscribe and hit the notification bell for more on money and investing. Knowledge is power in navigating the financial world. Brokerage fees can have a massive impact on your financial future. By understanding and comparing fees, you take control. Save on fees to compound your investments and reach goals faster. Make your money work for you. Don't let costs sabotage your efforts. Take control, do your research, and build your financial future. You've got this. Thanks for watching, and see you in the next video.